Okay, that's 10 o'clock on the dot. Thank you again, everyone joining. It's been a very interesting time in markets. So just to introduce us, you've got James and I think James is having a few audio issues. We'll crack on anyway. So what we're taking you guys through today is what's been an interesting March. You've had basically the volatility caused by the Silicon Valley Bank collapse. Other things have been the Credit Suisse collapse and basically the end of the rate hiking cycle that we're seeing out of central banks. So that's not just in Australia, but we're seeing that out of the US as well. So we'll take you through that, and we'll take you through what that could mean for the AUD, which has been relatively range bound over the last month. So what actually happened with SVB? Basically, the bank had a run against them. Simultaneous clients were taking money out. I think they recorded about a $1.8 billion loss. They then went into basically a for sale, and basically the Fed had to bail them out. After that, other central banks or other commercial banks started going into the same venue. Credit Suisse was one of them. And if you guys were watching the headlines over the last few weeks, they got bought out by UBS, which was, in our view, was a discount for how big that balance sheet was. But that was basically from confidence in the banking sector. Some people in the crypto space are saying that's going to basically revive Bitcoin. But we think different. We're also seeing other commercial banks doing the same thing. Deutsche Bank, to name a few, who has had a run against them this week. What does that mean for us? It's basically financial stability. People often see risk if there's a run on the banks, and that's not great for the AUD. Typically, we see the AUD sell off, and that's why we're trading around that 67 mark against the USD at the moment. What has that done for interest rates as well? If you guys recall, the last 12 months have been a continuous rate hiking cycle out of the Fed, the ECB, and the BOE. The RBA have also been doing the same thing. But with a financial crisis happening over there, we've seen a pause in most central banks. We'll talk about them specifically later on. I'm sure you guys are interested to see what happens with the RBA next week. So we'll go through that over these slides. So what's happened with increased financial risk? We've seen equity markets sell off. The US index has fallen about 4%, and the ASX has fallen about 6%. Especially after the CPI print yesterday, we did see a bit of a gain in the ASX. Expect basically if interest rate hikes continue to slow down, we expect that to bounce back. Typically what we see, if equity markets do bounce back, we see the AUD follow the same trend. So when you guys look at the news in the morning and you're seeing that the equity markets are down, expect the AUD to follow the same route. With the SVB crisis and with the banking crisis that we're seeing at the moment, we're now not really seeing any rate hikes expected out of most of the central banks. So let's go into detail of what actually happened. Basically, when Silicon Valley Bank collapsed, for lack of a better word, we saw a panic. Think about 2008, think about the GFC crisis where there wasn't confidence in the bank. There were too many deposits. So the deposits weren't covering the loans that they were having. And what happened was the Fed had to step in to actually bail them out. If a few people here who have gone through the GFC remember that the Fed did bail out some of these big commercial banks. They did say they weren't going to do it again, but Silicon Valley Bank, I think, was the 15th or 16th biggest bank in the US, and it wasn't right for the economy for them to fail, and that's why we had the Fed bail them out. and that's why the Fed have basically stopped or decreased the rate hiking cycle that they were on. So inflation became second priority to economic stability. Now, the Credit Suisse story was a little bit interesting. Basically, with Credit Suisse, it's been not to be mean about it, but it's been a failing business since 2008. There's been a run on the bank for the last 15 years, and it was basically a ticking time bomb. The UBS takeover was probably the best thing for them. We didn't really see too much contagion out of that compared to SVB. Arguably, the Swiss Central Bank and the European Central Bank handled the crisis well compared to the US. This week, you guys would have seen some headlines about Deutsche Bank. I think there was a bit of an overreaction. I think people are a little bit scared at the moment with week-on-week news about banking sector collapses, but we did see a run on them. We didn't see too much of a sell-off in Europe, and then we actually didn't see too much of a reaction in Australia. I think it's probably important to say in this forum that Australian banks are arguably the safest and the most regulated in the world. So I doubt we'd see something of this nature happen to them. And what's happened to the FX markets? Really interesting from a G10 sense. The yen, if anyone here trades yen, has been the best performing currency this year. That's after being one of the worst performing currencies last year. So guys who've been trading FX for a long time can assume that if, risk off or risk on, risk off typically sees the yen. Right, I think James is back now. Are you working, James?
All. Yeah, should be working.
Did you want to talk about the FX stuff, James? Basically, the impact of the banking collapses and what happened in currency markets, a bit more traditional moves, right? Aussie off, yen on, Swiss franc on.
Yeah, a lot of the stereotype moves that you would normally get at a time of high volatility and falling asset prices is the yen sort of clearly seeing some outperformance, not just ahead of Aussie and Kiwi, but also ahead of the US dollar as well. I think also just the fact that the US dollar does also work as a secondary safe haven. And then you've got the Canadian dollar, Aussie, Kiwi, the so-called commodity currencies. Those are off at the moment, just with the threats that are seen to global growth from the volatility that we have seen as a result of the banking collapse.
No, exactly. But, I feel like the USD is probably not the flavor of the month with regards to safe haven currencies. It's definitely been the yen, hasn't it?
Yeah, most definitely. It's broken out of a range against the US dollar, and most definitely not just against the US, but against the other safe havens. Traditionally, the Swiss franc would be seen as a safe haven, but with what's going on in their own banking system, that's been a bit of a laggard as well.
And then I guess moving on to the impact on rate decisions and rate hike expectations. I probably explained it really badly at the start of the presentation, James, but why is it so important, or why do we see all the central banks basically slow down or tone down the expectations of further rate hikes in the future?
Well, I think that's the immediate market reaction, and I think there's a bit of muscle memory from some of the older people in financial markets that in 2007, when we started to see financial institutions show sign of stress, and then we saw a couple of funds fall over. The initial thing was to go and cut interest rates, but very different scenario at that point, where interest rates had already been on hold for a year, and also inflation was only around that 2-3% mark. So financial markets largely are calling for rate cuts because, on the whole, most financial markets out there benefit when interest rates are lower, particularly your equity markets. But I don't know what you think, Patrick, in regards to how things have been going in the equity market. Is it actually warranted that the central banks should be slowing up on inflation and rate hikes just as they're starting to get it under control?
It's a tale of two. It's two tales, right? Do you worry about economic stability, or do you worry about inflation? I guess that's what the central banks are playing with at the moment, and it's a fine line that they're playing at the moment. Do they keep going? If they do keep going, the impact on financial stability, economic stability is going to be, not great, right? If the cost of funding is expensive, the wheel stops spinning eventually.
Yeah, definitely agree with that point.
So I guess with pricing, for the guys that have been dealing with us for ages, basically we get probabilities on when rate hikes are happening. And you can just see here that most punters, most bond traders, fixed income markets are saying that we are seeing the likelihood of further hikes to be much lower moving forward. Swirls, you're the RBA expert here, so I'm going to let you take this on, but I feel like this is really interesting looking at the pre-Silicon Valley Bank collapse in terms of probabilities to post, and basically the drastic shift in interest rates where we were upswinging in terms of rate hikes to possibility for cuts this year. I guess, are we going to see a cut this year?
Yeah, I think first off, we'll take on a lot more detail around the RBA's next move a little bit later on. But in terms of what we're looking at here side by side, this is just facts on the ground. What is on the basis of cash rate futures that have been traded on the market? What is the market's current placement of interest rates at the moment? As you can see on that left one that was taken on the 13th of March, the possibility of a hike at the April 4th meeting was seen as about 50-50. Whereas now, looking on the right-hand side, it's actually expected there's a slight chance of a very, very small cut. It's probably unlikely that they will cut. But what we're seeing is going forwards a year to December 5th, the market was expecting that interest rates would be about a point higher than where they are at the moment. Whereas now, going to the 5th of December, as of yesterday, it's expected that one or maybe even two rate cuts could be in place by the RBA, at least by the end of this year. So quite a reasonable shift in the way that interest rate markets are trading this at the moment.
So we're going to contradict ourselves in the next slide, and I guess you and I are in agreement here, Swirls. Despite rate cuts being priced in this year, we kind of warranted the last rate hikes that we saw out of the ECB and the Fed in particular. What was your term? You kind of called it a hike for confidence or something of that nature. They wanted to show markets
a face-saving hike.
Yeah, that's it.
Almost something that you would see out of an 18th century novel where it's all done for show, and doing the right thing to show confidence in the markets, as opposed to actually doing it because it's going to have some real merit. But in terms of what we're looking at the moment, maybe Patrick, if you could explain a little bit more about the bank term funding program, and to how that's affecting the point at the moment.
Maybe you can.
Now, the Fed's, what they've basically announced with the bank term funding program is essentially almost unlimited liquidity to support any banks that might be seeing some short-term funding pressures. And those short-term funding pressures would be coming along through liquidations, or essentially customers withdrawing money, and they need to liquidate their own assets in order to provide that money. So the Fed's basically announced this program. What that really means is that the Fed have got to have a whole load of money themselves available to lend out. And what that kind of goes.
I recall seeing a chart maybe last week or early in the week with the Fed's balance sheet actually growing again.
Yeah. So the whole point of this interest rate hiking cycle is that they were supposed to be shrinking the balance sheet, i.e. reducing money supply. And actually all that's happening at the moment is that they're increasing money supply at the same time as raising interest rates. Is kind of like having your foot on both the accelerator and the brake at the same time. So definitely sending the wrong message to the markets at the moment.
And just food for thought. What if the ECB and the Fed left rates on hold the last 2 weeks? Do you think that signals to the market that the central banks are worried? If this was a face-saving hike, if they didn't hike, was that the wrong move? Do you think I think hiking was the right move to bring calm and peace in the market? But what if they didn't hike rates?
I think that they've moved along with the course that they were at, and I think that just because there's been an issue with the banks, it shouldn't have changed something that they've been working towards for a few weeks. But I think they've got some big decisions to make now. I guess we'll go into each central bank individually, but central banks as a movement as a whole, they do all speak to each other on a daily basis. Recent discussions we've had where we were fortunate enough to speak to an RBA member. She's head of international, and her mandate is to be speaking to her colleagues at the other central banks constantly. And it feels like as a movement, they are ready to work together to start changing path as a whole. Doesn't necessarily mean the end of hikes in certain jurisdictions, but perhaps a general change in direction, almost like a ship turning direction.
That's a good segue then. So I guess they're working together. And one of the questions that we said we will answer in this webinar is the chance of a recession in Australia and the global outlook. At Ebury, Sparrows are very positive. I think we were in agreement with the analysts when we were making up the slides and doing the analysis that we're in pretty good stead. I feel like the recession chat is maybe a little bit of an overreaction, but we think that there's going to be no recessions to come, despite a higher cost of funding and increased interest rates. You're in agreement as well, Sparrows, I'm assuming?
Personally, feel that there's a lot of denial around recessions. We're obviously all positive people. We want the best, but in reality, interest rate hiking cycles do end in recession or some sort of global economic downturn. So you do have to look to history for that. Some good points there around China shifting away from COVID.
I think the China thing is massive. I feel like it's very underplayed at the moment, with them coming back into capacity.
I would agree. I think the fact that China are coming back online and energy prices are down, it's definitely going to be pretty good for ourselves and for emerging markets. But I do still feel some of those old school economies, UK and Europe, where inflation's still above 10%, even though interest rates have gone up so much, that's got to be an issue. And for America as well, they're so dependent on low interest rate environment for growth because of how much debt they're carrying, that again, I think it'll be quite difficult for them to avoid recession. But those economies are built on boom and bust. Not necessarily the case elsewhere.
But the thing is, right, PMIs are still relatively positive. They were contractionary for the latter part of last year, but that 50 mark that we're hovering around, it's kind of picking back up. Wouldn't you agree?
Yeah, there's no doubt it's picking back up in terms of on the surface of things, but behind it, some of the leading indicators of pipeline are down. That's not going to be felt for a few months, particularly more in the goods sector than in the services sector. But I mean, on the bull case, to agree with you, I guess we're a couple of months away from summer holidays in Europe and North America, and it doesn't look like there's any sign of retail slowdown at the moment. So we might be in for a bumper time to cushion the industrial sector with tourism at the moment over there.
Which means inflation is still persistent, isn't it? Yes, it's coming down, but it's nowhere near where central banks want it to be, right?
Yeah, I mean, we're all cheering 5.2% or 4.6%. I mean, those are levels that were just unimaginably high for so many years up until 12 months ago, 18 months ago, really. And the Eurozone UK numbers are absolutely eye-watering. The Australian number down at 6.8%, but on a lot of markets,
it's still above their target, right? It's still high.
There's some horrible components there in terms of rents, in terms of
the big one, yes.
Supermarket food prices. Essentially, your staple items are still growing at an enormous level. That is a great worry for the population as a whole. So that there's still a lot of work to do.
Yeah, exactly. I guess on that point though, we've seen it from, let's say, that RBA probability screen that we saw earlier, that we are expecting a possibility of a rate cut, but with inflation so sticky, a rate cut's justified this year?
Surely rate cuts is a difficult one to justify while inflation does still remain very high. That's where the central banks are going to be stuck. But I think with the first point that we have to get to is, when will they stop hiking, and will they do that for 2-3 months and then start cutting? I think the idea of we'll just one day turn around and just cut rates, there'll be a build up towards that, and the central banks are not even properly built up towards pausing, never mind actually cutting. So
I think that's such a good point that you just said there, that rates just don't go up and then go down. They will stay high for a period. There will be meetings of basic holds coming up. I think it's a bit naive to expect that central banks will immediately cut rates, I guess, from the general public if inflation is coming down, right?
Absolutely, and a good point raised by Justin, one of our viewers here, calling BS on the inflation figures.
Yeah,
and that's one that's been discussed for the last 10 years. When inflation was at 2%, people said, well, I don't believe that it's at 2%. It's actually much lower than that. Prices might even be going backwards. So same story that you have to agree with now that we've got inflation. There's plenty saying that they're underestimating inflation. There's equal argument that it's being overestimated as well. So
we need to knock on the door of the ABS and get them to get the sample size right, or get the basket right.
The basket more reflective of what people are actually seeing.
Exactly. Yeah. I mean, a fun fact I always find interesting in Australia, we only started reporting CPI monthly August last year. It was, I think, horrible that we were a developed nation and we were only reporting inflation on a quarterly basis.
Yeah, absolutely. It's good that we've got towards doing that properly now. Not only quarterly basis, but 2 months after the end of the quarter as well, to the point where it was almost irrelevant.
Yeah, spot on. It's old. It was old news when it came out. So the big questions that everyone wants answered, we don't know what will happen, but are more rate hikes in sight. We're going to go through the RBA, the Fed, and the ECB. Like I said earlier, James is the RBA expert. He's going to take you through 2 cases, basically the case for why the RBA should hike next week, and then another case for the RBA to hold next week. So over to you, James.
Yeah, thanks. I'll just sum it up quite briefly then. So the case for them to hike, and we're assuming a 0.25 hike as opposed to being back anywhere near 0.5. Inflation, we've had a couple of good months coming down from 8.4, but we're still at a 33-year high. It's still well above where the RBA wants it, and they've called repeatedly that their main job is getting inflation back to target, because there's bigger problems created by inflation being too high than by an economy being slow. Obviously, central banks, the calls to pause has been centered around banking sector stability. However, I would argue that Australia's banks have got possibly the greatest capital buffers in the world, definitely greater than American and European counterparts. You look at the banking crisis at the end of 2008 that essentially set back Europe and North America, set them back 5, perhaps even 10 years in their economic growth. Australia just sailed through it, really, and a similar sort of thing in the 1980s as well. But these days, I'd say we are not going to be hit by a banking crisis in the same way the rest of the world would. I think the other thing that's really important is, sorry, just on that same slide, is that the Aussie dollar is now 12% down compared to where it was in April last year, when all the central banks hadn't yet started with their rate hikes. The reason for that is we've been lagging behind the rest of our peers. Our interest rate is more than 1% lower than America's at the moment. So, and the reason for the currencies being weak is essentially it's all about yield. So if we continue to lag behind, or even that gap grows, then the Aussie dollar would be at threat of falling even further. And what that does is it's going to make imports a lot more expensive. Considering that most consumer goods in this country are imported, that's going to really reignite inflation in a big way and almost become a self-fulfilling prophecy. I think the other thing as well, really important, is typically Australian central bank action has been linked to Chinese activity data and also wholesale goods inflation. They definitely cut in 2019 as a result of that. And, in the past, these measures have been a positive driver for commodity prices and the Aussie GDP number. So, that's definitely something that's going to keep things going here, and that would mean that the economy has the kind of stability in order to actually weather further rate hikes, even if it does drag down spending. In terms of the other one, the rate hold, plenty of argument there as well. We've got an enormous proportion of homeowners on variable rate mortgages, and there's going to be a lot more coming off the fixed rates in the next few months. And compared with America, where you've got people who've got 30-year mortgages that were locked in at close to zero, that's definitely not the case here. Fixed rates were a very short term. The other thing really important is that our debt to income ratios here are very, very high. Not just in terms of household mortgages, but in terms of debt taken on for purchases of cars, for credit cards,
personal loans.
Yeah, we do a lot of it. And so as a result, increases in borrowing costs have felt far more acutely. And that's not just costs, but in terms of how quickly those costs are felt. So there's definitely been a case of that happening already. The RBA, in their statements, have consistently said that their monetary policy decisions are based on certain markers like employment, retail sales, growth, and inflation. And all of those have been deteriorating. So there's a good chance to say, well, why don't we use the hikes that have already been in place to continue bringing things down?
What about the 800,000 mortgages that are rolling from variable to from fixed to variable spirals? You're talking about high debt levels. I'm sure people are going to ask about, what does that mean for us? I guess what happens in markets then?
Yeah, I mean, that fixed rate cliff is definitely coming soon. What that really means in markets is that there's going to be a lot of movement of debt as refinancing occurs. And ultimately what that can mean is that there might be the odd household that's already thinking to themselves, well, I want to try and get rid of this property in the spring selling season before I end up moving on to a higher interest rate, going variable from my fix. So, talking about August, September, there could be a lot of properties moving at that point. Whether or not there is an appetite to be buying those properties is another thing. Is the economy going to be strong enough to support more people taking on mortgages to buy those properties?
Borrowing power, doesn't that decrease as well? As interest rates go up, the ability to borrow does decrease. So there might not be as much demand, just because the ability to seek finances, the barriers for finance will be greater.
Yeah, and risk appetite would be lower as well. I think the other thing that's important to just note is economists were saying consistently a few months ago that 3% would be the threshold at which the Australian economy would tank. So as we were well past that at 3.6% at the moment. But the damage isn't just going to be felt right now. It's going to be in the months ahead, and it will be in that fiscal cliff and so on. So with those mortgage levels, so is there a danger that they're just storing up the big crash for after the fixed rate cliff happens? So, you know, again, just another reason for them to just watch and wait, but not try and force it.
Yeah.
But I think what we really have is probably more, there could be a third option, a third dimension to this, rather than just saying the RBA is going to hike or they're going to stop. There's a possibility they might pause. What I mean by that is, well, we're always basically saying, well, for now, we feel that we can leave things on hold. But, you know, if we do see inflation really rearing up again, or if central banks elsewhere in the world suddenly get their foot back on the brake hard, you know, we might be in a position where we need to follow. So just because they do nothing in April doesn't mean that they're ruled out from doing something in May. And then, you know, in May, the RBA's meeting actually coincides with the Fed's within a couple of days of each other. So we might find
my fear with that, though, and I feel like, you know, it's important to say it in this forum, is if that does happen, if they go for a pause, you know, that yield gap between the USD and the AUD is going to stay for longer. And, you know, that only promotes a weakening of the AUD. So that's probably going to be the tough thing for most of the people in this call if the RBA decide to pause. Should we kick over to the Fed?
Yeah, good call.
Yeah. I'll say my view on the Fed, and then James can pop in. But it's been markets versus Jay Powell for a long time. In his last meeting, so they hiked by 25 points. Powell was adamant that the US banking sector was sound and resilient. And he was firm on his dot plot. Basically, the dot plot is what the members of the FOMC expect the rates to be over the next year, or next couple of years, rather. However, markets aren't convinced. If we would show you that same probability chart for the USD, the likelihood of further hikes, I think it's all underneath 100% now. So, you know, they're going to be playing between a pause and a hike. Interest rates are high, and we're slowly seeing an impact. Inflation is relatively resilient, but yeah, I just feel like Powell's not doing a good job in terms of passing on that hawkish statement. I feel like markets are calling his bluff. I don't know what you think about that, Swirls, but it's been definitely markets versus Powell.
No, definitely, and there's a history of that in America where, you know, ultimately there's a lot of very, very strong, powerful influences over the central bank and political. Ultimately, he was appointed by politicians, so politics.
As much as they're supposed to be independent, right?
No, there's nothing independent. I think the other important part to note is that the US Federal Reserve is the world's central bank. So much debt is denominated.
So much US dollar debt. Yeah.
Yeah. Exactly. So much for them to actually consider.
We're going to break a few hearts here for the importers on the call. Do we think we're going to see a cut out of the Fed next year? Or this year, rather?
Yeah, that's pretty strong case there. Very sharp move down. It does appear that that the market believes that that's where it's going. But for the time being, it looks like the central banks haven't quite caught up with that view.
Which goes back to my classic line of Powell versus the markets, right? He's saying no, but markets are saying we could see it. So I guess for the guys on the call, it's where you want to put your money on. If we don't see a US rate hike or a rate cut rather, then expect the Aussie to trade in the mid 60s. If for whatever reason, if that banking sector collapse continues, they could justify a rate cut in that instance. And we may see the 70 levels that we saw earlier in Feb, especially for guys dealing with the USD. And last but not least, I call them late to the party, James, the ECB. So they only started the rate hiking cycle recently. We're the last, I think, in terms of the major central banks to catch up. Do we expect more hikes out of them? And we're definitely seeing it in the euro in terms of that strength. And I guess going back to what you were talking about in terms of the yield gap, they are definitely playing catch up, and it's definitely reflective in the currency, if you think.
No, I definitely think with the ECB, that the ECB has basically been like the person who's late to the party and who just stands at the bar and drinks loads of shots and then ends up going home first. They've done it before. They raised interest rates too quickly in 2011, having just only weathered a banking crisis in 2010. And that essentially set them back for a decade, where they had interest rates at zero or below zero even. They've been slow to jump on. Then inflation's leapt higher, not helped by energy prices going up so much because of the Russian energy pipelines. But they're now raising very, very sharply. It does look like though they will be first to feel some pain. So
yeah, but Aussie euros, just if I could name a currency that's been hit hard, yes, Aussie US is trading in the mid 60s, but Aussie euro is about to break 60 cents. Do you think that's going to continue?
I think there's pretty reasonable support at these levels for Aussie euro. I'm not saying I think that we're going to get back up to say 64 or 5.
65, 67 last year, was it?
Aussie euro can trade in a range-bound fashion for a long time before suddenly surprising you. It's just actually very interesting that in the last 12 months, it's surprised us twice, going up to 70 where it hadn't been for so many years, and then coming all the way back down again. But the Aussie euro rate can stay very range bound within a 3-4 cent range for a long time. But when it does move, it really moves quickly.
No, you're not wrong. It definitely is one of the harder currencies to, I guess, find the trend on, because it's very surprising. The Eurozone's massive. Lots of factors from Ukraine, Russia, energy prices, several economies, inflation in the mid-teens is what they expect it to be. So yeah, very unpredictable with what happens there, I guess, especially in the next coming year. And that's it, James. That's the last slide. Did we have any leaving remarks that we want to leave the guys who were so kind to join the webinar today? It hasn't been the best month. March, the Aussie has definitely been on the lower side of the trading range. Do we have some good news to tell them from next week, or what do you think?
Look, I think the main thing is how range bound the Aussie has been over the last few weeks.
3 weeks, yeah.
And it's not often that you see it so range bound, and typically the tighter it gets, the more sharp the move is when something actually happens. So whatever happens, we're going to see a 4 or 5 cent move, and typically it can be triggered by something completely unexpected. So I guess that just comes back to really why we're all here, which is that all we can do is create certainty in our businesses by having a strong plan on currency, around being as informed about the market as we possibly can be, but ultimately respecting where our costs are, and using the instruments that are at our availability in order to actually protect those costs and to ensure that our business's profitability is maintained.
Exactly. And if you guys want to know more about, what you can do to, protect profits, hedging, that type of stuff, I see a few clients in this call. You've got our emails there. You've got our numbers there. Just feel free to give James, myself, Nathan a buzz. Always happy to have a chat further about this stuff. And that's it. Thank you again, guys.
Thanks for listening, everyone.
Have a great Thursday. Thanks, James.
Cheers, Patrick.